The multi-billion-dollar deal that would merge two of the most powerful business families in Canada, Rogers Communications has agreed to buy its rival, Shaw Communications, and red flags are already being raised about what it could mean for consumers. The transaction is valued at $26 billion, including $6 billion in debt. Rogers and Shaw carved up Canada when it came to cable and internet service. Rogers operated in the east and Shaw in the west, but they have been fierce combatants in the wireless sector. Now, Rogers is promising to invest $2.5 billion to build 5G networks in Western Canada, plus $1 billion to give rural, remote, and Indigenous communities high-speed internet. It's also promising to create 3,000 jobs in Western Canada. Big money and big promises. None of it will happen unless the deal gets federal approval, and that will include explaining why less competition is good for consumers. Mike Drolet has our top story tonight.
For generations, Rogers in the east and Shaw in the west played in their own backyards, while the invisible fence between the two could soon come down if telecom regulators approve Rogers buying its western rival to build out its 5G network.
This is all digital and wireless. I mean, this is the future of the world, right?
Bell is the undisputed top telecom company in the country. Merging Shaw with Rogers levels the playing field while leaving consumers with one less cellular option. As part of the $26 billion deal, Rogers is offering up some promises, one of which is customers of Shaw's Freedom Mobile won't see a price hike for 3 years. But telecom experts agree the math adds up to one thing: higher prices.
This is a long game. It's nice to know that your costs may not be going up for at least a couple of years or 3 years, but we know that in the long term they will. And that absence of competition in many ways really guarantees the notion that costs will go up if this merger goes through.
Politically, that could create a problem for Prime Minister Justin Trudeau, who promised in the last election to reduce cellular bills by 25% over 2 years.
Everyone complains that they're paying too much for cell phone service.
Comparing 2 gigabyte plans shows Canadians are paying $74 on average, compared to $60 in the US, $25 in the UK, and $22 in Australia. As part of the deal, Rogers also promised to create 3,000 new jobs in the West, while maintaining a regional office in Calgary, where Shaw is based.
Maybe that'll continue and maybe it won't. The likelihood of the sophisticated jobs staying in Calgary, frankly, is low. It's going to shift. Over time, it'll shift east. It almost always does.
So if the prices go up and the promise of jobs doesn't pan out, will the benefits of an operational 5G network be enough? Will Mitchell of the Rotman School of Business says if you look at the bigger picture, it has to.
And imagine we don't have sophisticated 5G, and the US does, and China does, and Korea does, and the rest of the world does, and we're trying to compete on 4G or mediocre 5G. We lose.
The deal is subject to regulator approval and won't be finalized until sometime in 2022. Mike Drolet, Global News, Toronto.
There is lots to digest in this deal. To help us break it down more, Anne Gaviola, our new senior business correspondent, is with us. And welcome. Rogers and Shaw are framing this deal as a win-win for everyone. The press release says it will generate more choice and competition for businesses, as well as realizing the full benefits of next-generation networks for Canadians and Canada's productivity. How much of that, Anne, is hype and how much is true?
I would take that with a grain of salt. I mean, keep in mind that messaging is coming from the people trying to get this deal pushed through. Every analyst and industry expert that I've spoken with says no matter how you slice it, this looks like, basically based on the way that it's been presented, it's going to equal less competition and higher prices for consumers across Canada. And in addition to that, even though there is a lot being promised here for Western Canada in terms of new jobs, you do have to sort through some of that corporate speak. And buried in there is the fact that Rogers expects to realize annual cost savings of about $1 billion in the 2 years after this deal goes through, if that does happen. And a lot of people are saying, you know, that could come in the form of job cuts, maybe not necessarily in Western Canada, but in other parts of the country.
And this is not a done deal. It needs government approval. What's your read on that?
Right. It's going to be an uphill battle for sure. There are still a lot of stakeholders that need to sign off on this. If you take a look at what happened to Shaw Communications shares on the stock market today, it looks like investors do not believe that this deal as presented is expected to pass. They've been trading shares of Shaw Communications below the Rogers offer price. And in addition to that, there are several regulatory hurdles that this needs to jump over. So the CRTC is going to be scrutinizing this, as well as the Competition Bureau, the Ministry of Innovation, Science and Economic Development has to weigh in on all of this. And this would set an important precedent as well. It would effectively, decrease competition, which is the opposite of what federal policy has been trying to do here across Canada over the past decade.
All right, our senior business correspondent, Anne Gaviola in Toronto. Thanks.